IV analysis for overnight trading. IV means implied volatility, which is an important element in pricing the premiums for options. It's usually a combination of how much time is left in the contract as well as how volatile the market is for that stock. This means the higher the IV, the more premium you will pay for that option. Now, option in the money has intrinsic value. There's actual value to that option if you cashed it out. But there's a premium on top of it, which has to do with time. How much time value is left? How long before that option expires? Further out, the more premium you're going to pay for that time. If it's closer to expiration, the less you'll have to pay in time premium. But there's also the IV. How volatile, how much of a move could this stock make based on its recent history? And if that move could be high, well, you're going to pay a premium for that too. If you buy an option out of the money, there's no intrinsic value, meaning if it expired right now, it would expire worthless. When you buy an option out of the money, that is only potential value, but once again based off of time and IV, volatility. When we trade overnight, volatility is important. We want there to be a good move so we have the opportunity to make more money. Overnight swing traders hate flat markets or low IV. If the stock does not move overnight, well, chances are we could lose money on both our calls and puts. And what I mean by both our calls and puts, well, as an overnight swing trader, here we use SPY T trading, which is generally a ratio trade of 2 or 3 to 1, which means we have a hedge. Because we can't stop out overnight, we use a hedge to protect ourselves. But again, if the stock doesn't move, we could actually lose money on both directions. As a SPY T overnight swing trader, we generally like IVs ranging from 20 to 30. That means if for some reason our indicator is wrong and it moves far the other direction, we could actually still make money or definitely seriously minimize any loss. Now, there are a couple warnings about IV that I'll share with you in a moment. When I first started overnight swing trading, the IV for SPY, which represents the S&P 500 as an ETF, was highly volatile. The IV was over 20, even over 30 at times, which means there was good movement, great opportunity to make gains overnight. Even if we were wrong, our indicator may have said up, but then there was a big down, and we still made money the other direction with our SPY T trades. However, over time, the SPY volatility started to come down, and sometimes it came down really fast. And when that happens, it's often referred to as an IV crush, meaning the premiums came down so fast it doesn't even matter if you were right about your trade. The premiums came down so much you lost money anyway. Now, this can happen in other situations too. Let me explain. Whenever there are high expectations of movement in the market, maybe because of a high valued stock such as Facebook, Google, Nvidia, Amazon, and the market is waiting to see what happens, or possibly a government report such as CPI or PPI, the market makers will start to inflate the value and, quite honestly, artificially inflate the value of those options. And so once the news hits, quite often that extra inflated premium will deflate overnight. And so you may be right about the direction of the stock or ETF or market. However, the deflation of the premiums puts you at a loss anyway. That's one advantage of trading the same stock over and over again. You can notice when premiums have been jacked up, then you need to figure out why, and sometimes it's a good idea just to avoid the market when that happens. There are 3 parts to an overnight swing trade. The first part is the time, obviously overnight. For SPY tomorrow, we buy at the end of the trading day and we sell in the morning. The other part is our hedged trade, a 2 to 1, 3 to 1 options ratio, and of course the signal. Now, our signal is at spytomorrow.com, in which it shows either an up or down signal, and that's what we base our trade off of. Our main algorithm is based off of the SPY, but that doesn't mean we want to trade the SPY all the time because, again, due to volatility, it's so low. Even the QQQ is getting rather low right now, so we've been trading the IWM, but you can also look for other stocks or ETFs to consider. You can use the tools in your brokerage account to help you find high IV stocks. One place I like to go to do some of my research is barchart.com. This is not an endorsement, I'm just saying this is what I like to use. Let's say, for example, you head on over to barchart.com and you look at the ETFs with high IVs, and you come across SOXL, which is a leveraged semiconductor ETF with 3 times directional trading. The IV on the stock is almost 130%, which is extremely high. So I want to take a look to see if it's actually tradable using our system. This is when I go back into my brokerage account and I look up options SOLX. Because the underlying value of the stock is lower than many of the ETFs that we trade, such as SPY, QQQ, or even Apple or Tesla, which are hundreds of dollars, this one's only $40. So the cost of the options are also lower. So I want to look at the option chain. If our indicator said up, a call would be about 180 and a put 170. So what we can see here is that there is a larger bid to ask spread, which usually is an indication that it's not as highly traded as we see from SPY and QQQ, which means it could take a little bit longer to get in and out of the trade. Plus, we're going to have to be a little more savvy about getting the best price we can as we get in and out of our trades. But what I want to see is how this option reacts to our SPY-T trades, such as a SPY-T-BT trade, which is a common one that I use. So if my indicator said up, I would buy either the 40 or 41 call. Let's say I bought the 41 call for 136, and then I need to find a put 1/3 the price, which would be the 36 put at 42 cents, which would be a total of 178. During this experiment, we're not taking into account theta, but we should take a look at that in a few moments. I have noticed in the last few days that this ETF will move $1, $2, or $3 at a time each day. So let's say it moves $1 in our favor. That means the next morning we could sell the call at 164. Yeah, see that bid ask? That really makes a difference. And the put at 23 cents. So yes, we would have made money, but it would have only been 5% for such a move. What would have happened if it went the opposite direction? Well, we could sell our call for 95 cents and our put for 55, which means we would have lost about 16%. So the upside was 5% and the downside was 16%. And looking at the theta, which is about 8 cents, which means if there was only a $1 move, we may have only broken even and lost even more if our indicator was wrong. Now comparing the IWM with an expiration of about 6 days, similar to the other ETF, the IWM has an IV of about 21. And of course, the underlying value of the stock is much higher, so the percentages are different in comparison. However, we'll stick with about the same option prices. So we'll buy a call at 202 for 132 and the 194 put for 40 cents. 132 plus 40 is 172, very similar to the other ETF. Using a similar methodology, if the market went in our favor, we could then sell our call for 168 and the put, which went down in value, for 27 cents. Divide this by 172, and that leaves us with a 13.3% gain. But also note, this move is a much smaller percentage than the $1 move for the $40 ETF. Again, if the market went against us, we would sell our option for 99 cents and our put that would have gone up in value for 52 cents. Divide that by 172, and that would be a 13% loss. So as you can see, the gain and the loss would be similar. Of course, this does not consider theta, the time decay overnight. However, it does indicate a much safer strategy or safer ETF or stock to use the SPY-T trading system. As we search for our high volatility stocks and ETFs, we want to make sure that the IVs are definitely above 20, perhaps above 25 or even 30. Now you can find stocks and ETFs, as we've seen, with IVs above 50 or 100, but definitely do your research. Make sure there's enough volume and liquidity to get in and out of those stocks easily. Higher volatility stocks, ETFs, and options will also help us get better prices as we get in and out with tighter bid to ask ratios. You're going to need to test your bidding strategy ahead of time, whether you use the SPY-T-A, SPY-T-B, SPY-T-Q. You need to make sure that it's going to work in both directions. And how much of a move do you need for your trade to be successful? I generally recommend that you focus in on a specific set of stocks or ETFs. Become the expert in those stocks and ETFs so you know the price action. You know what to expect when earnings comes around or special reports from the government come around. How will that option premium react? Are you going to get a big pump up and then a IV crush? Do you need to stay away from that? What is it that you need to know day after day in terms of what the expectations may be of that stock or option each day? As you get to know the stock, options, and ETFs, you'll be able to trade them better. So you don't want to start with something that is temporarily high, meaning it shot up with a high IV, but traditionally it's a very low IV stock. You want something that's consistent, something that has high volatility all the time, but with high volume and is easy to trade within the system that you're comfortable with. If you're using a signal such as the SPYtomorrow.com up or down signal, you want to make sure you're using a stock or option that generally is in sync with the market. So take a look at the history. How does it compare to the SPY? And if it generally goes up when SPY goes up and down when SPY goes down, that's a good option. And especially if it has more volatility, it may give you more opportunity in the long run. Now, we often like to use QQQ, and that tends to sync with SPY. We also use IWM, and that doesn't always sync with SPY, but it has more volatility, and that's why we've been using it more as of late. So what are you using for your overnight swing trade? Let me know in the comments below, and I'll see you in the next video.